a lot of what they're doing here is trying to get market actors to hold government securities.
Pretty much, yeah.
Yeah.
And when you're comparing government securities to other assets, right? There's other things you're kind of competing with, like bank deposits and things like that. And so when they control one thing, they kind of have to control the full spectrum to make sure that there's no competitors that are really obviously better. And so what they did was they banned gold, right? So they
Take
add
away the
frictions.
options, right?
Yeah, take away the options or at least add friction. So they banned gold, which as we covered before was hard to enforce, but it certainly lowers the desirability of gold now that it's like a contraband. So, now it's like an illegal substance. So you basically reduce the attractiveness of gold, and then when you're focusing on remaining interest rates, the key pillar is yield curve control, which what they describe here as government securities price support. And so basically during the 1940s, the Federal Reserve made an agreement with the Treasury and said that they will basically do yield curve control on the entire Treasury curve. So the short end of the curve, they were willing to, they basically had an unlimited bid. They could, because they can print money, they can print base money, they can have an unlimited bid to buy Treasuries if they start to go above a certain yield, which means below a certain price. And because it's an unlimited bid, assuming that they stick with it, that can override all market forces. And of course, the only constraint to that is that you lose value of the currency. But that's why they then go and block the exits as much as possible. So what they did was for short end treasuries, short duration treasuries, they would lock them at 0.3%. And for long duration treasuries, they were locked them at 2.5%. And so the whole kind of risk-free government bond, yield curve was a positive curve that was submerged below the inflation rate. And they would support that by buying those bonds. And in the beginning, they had to buy a ton of them. But eventually the market kind of understands that this is not going anywhere. And so they start just holding it, because if you accept the fact that you're stuck in this environment, then it becomes a question of, okay, what is better than the other? And so, for example, they say, okay, well, if the short end is near zero, I might as well buy the long end, because at least I'll get some yield in this. Otherwise, it's less negative in real terms if you have the longer end. And there's basically, they start viewing it as a positive because there's no downside to that bond. Normally, the downside of long duration treasury bonds, you're still nominally risk free. You generally have higher interest rates unless you're in a period of yield curve inversion, but the downside is you have more volatility, right? You could lose quite a bit of value in a short period of time if the yields go up. But if there's yield curve control, suddenly those long duration bonds are pretty attractive. And that's actually what makes the 1940s different than the 70s. So in the 70s, the way to protect yourself, other than owning things like gold and commodities and things like that, if you had to be in bonds, you'd want to own the short end, because the short end could keep adjusting. Every 3 months or so, let's say you're holding 3-month T-bills, as the rates rose with inflation, which is what happened in the 70s because debt was low and they're trying to quell inflation. They weren't really doing financial repression anymore. It was smart to hold the short end of the curve because you kept, your rate would constantly adjust higher to keep up with inflation more or less. Whereas in the 40s, because they're doing yield curve control, it was actually made more sense to hold the long end of the curve, because if you were stuck holding 0 or holding 2.5% while inflation's averaging 6%, given the choice, you'd pick 2.5%. And so it created a different dynamic for what part of the treasury curve was attractive. And basically it makes it so that once market participants understand that that's the environment that they're in and that the exit doors are blocked, they start they start controlling the pricing for the Fed. I mean, every time yields would try to get above a certain value, the commercial banks would just buy those treasuries because they know that if they persistently stay above that value, they can just sell them to the Fed and get a spread on the price. And so the market starts kind of policing itself once they determine that the central bank is credible and that that basically they will backstop anytime it does start to persistently go above that level. That's kind of the key thing, is that credibility, which is of course is kind of in this sense a bad type of credibility. The credibility that they're going to continue with their price controls essentially. But once they understand that's going to happen, they start self-policing. And so that's the key thing. That's kind of what makes the whole thing work, along with blocking the exits. And then from there, they say, okay, well, now we want to make it so that there's restrictions on deposits, there's restrictions on margins. Of course, gold is banned. And then we use various either regulations, either force the banks to do something or heavily suggest to the banks that they do something like hold treasuries. And so those are essentially the toolbox for ensuring that rates are below the prevailing inflation rate, which helps liquidate that government debt.
Wow, it's quite interesting. So this idea of once market participants kind of accept the position or situation, or to use a stronger word, maybe the trap that they're in, they just realize that they're incentivized to buy the lesser of two evils, I guess. You just buy the long end of the curve because it yields more because you have no other option versus.
Yeah, pretty much.
But then you said in certain environments, like I guess probably like the environment we're in today where rates are ticking upward, that you can have an incentive to hold the shorter term duration just so you can adjust every 3 months. Is that right?
At least, yeah, currently, right? So in the 70s, short-term rates would adjust higher. And so you wouldn't get, if you hold a long duration treasury and you lock it in for 10 years, that's not going to adjust on a regular basis. You have one or two choices: either sit there and hold it, and you're stuck at a low rate since before inflation began, and now that inflation's here, well, that's still the original bond that you're holding, or you can sell it at a loss because the market adjusts and now is pricing that at a higher rate, which means they're buying the bond at a discount from you. And so people have either a real or a nominal loss on their long duration bonds, while the short term stuff is better because it doesn't really lose value and it keeps adjusting higher. That's in the 70s. In the 40s, when the short end was locked as well, it actually made more sense to hold the long end. In the current environment, in the very near sense, it has been better to hold short duration stuff. So it's been better to hold cash. It's better to hold short duration treasuries because the long end has lost value. But I think, in this environment, we're still early in the story, right? The Fed has not committed to yield curve control yet. And so I think, this story is not fully written. And it remains to be seen what part of the curve will make sense to hold for the long, for the whole decade, let's say. If yields stop going up and they start to, continue with their financial repression to some extent, then it'll start to accumulate where it's better to hold the long end of the curve generally. But of course, the whole spectrum is risky because you're almost certainly going to lose out in real terms either way. And the closest example we're seeing now is Japan. I mean, they're the ones doing formal hard yield curve control, where they're holding the front of the curve slightly negative, and then they're pinning the 10-year Japanese government bond at 0.25%, which is much lower than the U.S. did during the 1940s. And they have much higher government debt as the U.S. had back then. And so they're pinning that pretty aggressively. And in the beginning, during this kind of early part, the market has been fighting it pretty hard. But at least as of this recording, that's died down a little bit because the market seems to be currently accepting that the BOJ is going to protect that spot. But again, that's still pretty early in its overall defense of that peg. And so I think that there could be later rounds of the market really trying to see if the Bank of Japan is serious about holding that peg or not, because like I said before, a lot of it comes down to the market's understanding of how serious the central bank is at holding that line.